Number 4 is inducement, and this is another liquidity concept that can get very technical, but essentially you just want to see, is there available liquidity in front of the zone? Why? Well, same reason as before. Institutions are going to need that opposing liquidity to enter the market with minimal slippage. Here you can see there is available liquidity behind this low for institutions to use to buy against. But if there isn't any available liquidity, then very often these zones are traps and they will usually fail. Here you can see that there is absolutely no available liquidity in the leg, so this is a very obvious trap as institutions will not be selling here. Number 5, is the zone stacked with another higher time frame zone? The more you can stack zones across time frames, the more orders there should be in that area, increasing the probability of the move. Number 6, do you have alignment with the higher time frames? Because the more time frames that you have aligned, the higher probability of that trade. Here it might look like a high probability sell to follow the bearish trend on the M5, but the M15 is bullish and it's just mitigated the M15 demand at the strong M15 low. So now the M5 is likely to also switch bullish. Understanding multi-time frame analysis will help you to avoid a ton of losses, as time is power and the higher time frame will usually win. Number 7 is the zone well priced. Generally, the highest probable demand zones will be buying in discount prices, which is in the bottom 50% of the range, or selling premium prices in the top 50% of the range. This also improves your risk reward because we want to buy low and sell high, right? And last but not least, number 8, is the zone unmitigated? It's just a fancy way of saying, is the zone completely fresh or has it already been touched? Because if you see a zone with touches, then it's very likely that a lot of the resting orders within that zone have already been filled. So I try to focus on zones that are completely fresh, as these usually give the strongest move when price mitigates them. Now, combining as many of those confluences together are going to give you the highest probable institutional demand zones to trade from. So